Before we dive into this advanced technical analysis, it is absolutely fundamental to remember that trading foreign exchange and financial products involves a significantly high level of risk. The markets are inherently volatile and may not be suitable for every investor profile. All the content in this tutorial is strictly for educational and informational purposes only. It does not constitute, under any circumstances, financial advice or specific investment recommendations. You are solely responsible for managing your own capital and for every decision you make in the live market. Welcome back to another price action tutorial. Today, we are going to perform a comprehensive breakdown of the euro-dollar pair, using an 8-hour timeframe to establish a crystal clear macro perspective. As you can see from this initial look, we are facing a very interesting market structure. Price has shown significant volatility over the past few months, leaving behind institutional footprints that we are going to learn how to read today. It is vital to always start with a clean chart, free of any distracting indicators, to correctly identify macro levels and understand the primary market direction before looking for any type of trade entry. In this second stage of our technical analysis, I have proceeded to mark the most relevant swing points in the recent price action with white circles. Take a close look at how identifying these highs and lows allows us to visualize the market structure in a much more organized and logical way. By marking these specific levels, we can clearly see the rhythmic transition between aggressive impulses and corrective pullbacks. Learning how to correctly identify these swing points is the fundamental step in understanding whether we are riding a healthy trend or if the market is starting to lose momentum and preparing for a major reversal. To trade successfully and professionally, it is mandatory to master the core technical terminology of market structure. As you can see detailed on your screen, we classify price movements into 4 essential categories. On the top side, we have higher highs and lower highs for our peaks. On the bottom side, we identify lower lows and higher lows for our troughs. Understanding these concepts is not just a matter of basic theory, it is the real foundation for spotting trend reversals. If price stops creating higher highs and starts aggressively breaking through previous lows, the market narrative is shifting, and we must be able to adapt our strategy immediately. With our market structure already identified, it's now time to apply one of the most powerful and widely used tools in institutional trading, the Fibonacci retracement. In this scenario, you can observe my settings window with the exact levels we are going to employ for our strategy. It is of utmost importance that you calibrate your tool to display the key levels, the 0 point, the 0.236, the 0.382, and the equilibrium level located at 0.5. However, I want you to pay very special attention to what we call the golden pocket, which sits between the 0.618 and the 0.786 levels. Historically, these levels are where price has the highest probability of finding support or resistance after a strong impulse. Take a few seconds to copy these exact values into your own trading platforms. Now, take a look at the true power of price action when we combine multiple technical tools together. After that strong bullish impulse that broke through previous highs with clear intent, price begins what looks like an orderly pullback. I have drawn a purple rectangular area here that we call a demand zone. Notice the precision, this zone perfectly aligns with the Fibonacci retracement levels we set up a moment ago, specifically between the 61.8 and the 78.6 levels. This confluence indicates a high probability reaction zone. Additionally, at the top, I've marked the BSL level, or buy-side liquidity. This is our primary institutional target. It is the area where buy orders and sellers' stop losses are resting, which the market will likely want to hunt. To get a much sharper visual perspective, I have drawn this yellow structural trendline connecting the key swing points of the bullish move. Notice how this line perfectly highlights the initial upward drive, the deep pullback into our primary interest zone, and the subsequent explosive expansion to the upside. We don't draw these lines just to trade the simple bounce of the line like novice traders do. Our goal is to visualize the velocity, the angle, and the overall health of the market. See how the price, after finding support at the lower order block, regains its momentum with incredible strength, breaking through previous levels with large-bodied candles and very little rejection. Now, we are going to take our professional analysis to the next level. In this scenario, I have marked the daily liquidity levels, which serve as the roadmap for any institutional trader. The upper green lines represent the PDH, or previous day high, meaning the peaks from previous trading sessions. Meanwhile, the lower red lines represent the PDL, or previous day low, which are the troughs of past days. Notice the large amount of accumulated lows we have sitting at the bottom of the chart. The market constantly moves by seeking out liquidity from one point to another. By identifying these historical levels, we can predict with greater accuracy where large institutions might look for counterparties to execute their massive order volumes. We are now switching over to the 12-hour timeframe to refine our entry zones even further. I've identified two fundamental institutional concepts here, the 12-hour order block and the fair value gap, which you'll see labeled as FVG. A fair value gap represents a real imbalance between supply and demand. It is an area where price moved so rapidly that it left behind inefficiencies in the price delivery. The market tends to act as a magnet toward these gaps, often returning to fill them to balance the price before continuing its primary trend. Notice how these levels align right above our previous daily lows, creating a massive confluence zone to seek equilibrium. An advanced detail that marks the difference between an amateur and a professional trader is the NWOG, or New Week Opening Gap. I've highlighted it with a small yellow box at the top of the price action. This is the price gap created between the Friday market close and the Sunday night open. These weekly opening gaps very often function as invisible support or resistance levels of great power. Look closely at how price reacted with pinpoint precision exactly within that zone after its last expansion. Understanding the exact point where the market opens each week provides us with a crucial statistical edge when defining the overall weekly bias. To make sure these concepts are locked in and there is no room for doubt, here is the clear definition directly on the chart. PDH stands for previous day high, and PDL stands for previous day low. These aren't just decorative labels, they are high-friction zones where a massive amount of retail stop orders are concentrated. Institutions need these levels to find the necessary liquidity to move their large capital volumes. Whenever you see price approaching one of these levels, you should be on high alert for a potential liquidity sweep or a violent rejection, as this is exactly where the best reversal opportunities are born. In this detailed scenario, we are highlighting the 12-hour fair value gap with these yellow arrows. I want you to observe the size and the importance of this market inefficiency. It was created by a massive expansion candle that left a total liquidity void in its wake. By its very nature, price always seeks efficiency, so it is highly probable that it will return to test at least 50% of this gap, a concept known in institutional trading as consecutive encroachment. By combining this void with our previous analysis of highs and lows, we get a clear roadmap that allows us to trade with confidence instead of relying on simple guesses. We're heading back once more to the 12-hour chart to take a close look at how price interacts with the NWOG and the fair value gap we marked. In this scenario, we see that these levels are acting as very solid institutional support zones. It is fundamental to have the necessary patience to observe how the candles close and how they respect these areas before making the decision to look for a bullish continuation. The visual confirmation in these high sensitivity zones is what separates a winning trade from a losing one. In this specific scenario, we are putting the focus on the 12-hour order block. Observe closely that the price is staying in a consolidation phase right above this demand zone. This sideways behavior indicates an accumulation of orders. It suggests that major financial institutions are actively protecting their long positions at this price level. We don't want to enter too early, instead, we wait for the liquidity to be captured so we can move along with the smart money. Now, we are scaling down to the 8-hour timeframe to accurately identify our primary exit target. I've clearly marked the BSL, or buy-side liquidity, at the top of the range. Remember that the market always has a magnetic target. It seeks out these external liquidity zones after finding solid support in an internal order block like the one we analyzed earlier. This level represents our logical take-profit target within the current structure. Finally, if we analyze the 4-hour chart, we can see a truly powerful confluence of targets. We have BSL liquidity levels aligned on both the 8-hour and the 4-hour timeframes. When targets from different timeframes coincide at the same point, the probability of our trade's success increases exponentially. This alignment gives us the necessary confidence to hold our position until price reaches the institutional liquidity taking zone. We're going to drop down even further, to the 15-minute timeframe, to observe the microstructure details. Here, we clearly identify what we call equal highs. This resistance level is a critical liquidity zone because resting above those highs are thousands of stop-loss orders from retail sellers. Institutions often push the price toward these points to trigger those orders and gain the necessary counterparty before making an expansive move toward higher levels. As you can see by the label I've placed, this is our key level broken zone. Price has managed to break through the equal highs with a strong candle of intent, confirming what we call a key level broken. This breakout is not an accident, it is the technical confirmation that demand has absolute control of the market right now and that price is now completely free to go and hunt the macro liquidity targets we defined at the start of our analysis. To conclude this advanced tutorial, in this final scenario we propose two possible paths for the price movement. Path 1 looks for a direct extension toward the 8-hour highs, while Path 2 considers a possible technical pullback into the lower order block before continuing its ascent. If you value this type of professional technical analysis and want to keep learning how to read the market like a pro, I invite you to collaborate with the channel. Subscribe right now, hit the like button, and share this video with other traders. Leave a comment with any questions you have, as I have a huge amount of valuable content and strategies that I want to bring to this community. Thanks for your time and I'll see you in the next trade.